Welcome to today's Explainer. For decades, Japan has been an absolute titan of the global economy. It's a powerhouse. Yet, right now, its currency is in a total freefall. It's honestly baffling casual observers. So today, we're going to figure out together what's really happening beyond those simplistic, flashy headlines. We're going to peel back the layers and look at the deep, historical, demographic, and structural forces that are fundamentally reshaping Japan's place in the world.
To really get a sense of this, let's just look at the numbers. Back in 2022, one US dollar would buy you about 115 yen. Fast forward just a couple of years to today, and that exact same dollar buys 160 yen. The currency has literally plunged to a 40-year low. And this is completely flipping everyday life upside down. It's making imported food incredibly expensive for locals, while simultaneously turning Japan into this famously cheap playground for over 40 million foreign tourists. Suddenly, that dream vacation to Tokyo, it's basically half the price it used to be.
Here's a quick look at what we'll be covering today. First, why the yen is actually losing value, followed by the interest rate gap and the carry trade. Then we'll dive into the lost decades and deflation fears, why the export giant is struggling, energy imports and pension funds, and finally, 3 possible scenarios for where the yen goes from here. Let's get right into it. Section 1. Why is the yen losing value? So, to kick things off, we really need to look at a core paradox here, which is perfectly summed up like this. A strong economy doesn't always mean a strong currency. People just kind of assume that because Japan boasts ultra-low unemployment and global titans like Sony and Toyota, its money must be rock solid, right? But foreign exchange markets, they care far less about current stability and far more about where they can squeeze out the absolute highest future returns.
Section 2. The interest rate gap and carry trade. Okay, so this brings us to the most direct, mechanical cause of the yen's massive depreciation. You've got US interest rates sitting pretty high, right around 5%, while Japanese rates have basically hovered near zero. Imagine you're an international investor with $10 million just sitting there to park. Are you going to leave it in yen? No way. You're going to flee straight to the US dollar to grab those near 5% returns. And every single time an investor does this, they sell yen and buy dollars. That massive sell-off constantly pushes the yen's value down.
In the finance world, this operates through a maneuver known as the carry trade. It's honestly kind of like a financial cheat code. Here's how it works. Step 1, an investor borrows 1 billion yen at a tiny 0.5% interest rate. Step 2, they convert all of that into US dollars. And step 3, they buy US bonds that yield 5%. They just pocket that massive difference with virtually no effort. Now multiply that by billions of dollars executing this exact trade constantly around the clock. You can see how it acts as a massive, crushing weight on the yen.
Section 3. The lost decades and the fear of deflation.
Now you might be wondering, if interest rates are the big problem, why didn't the Bank of Japan just raise them when the US did? Well, the answer is trauma. Going back to the late 1980s, Japan had a financial bubble so massive that real estate in Tokyo was allegedly worth more than all the real estate in the entire United States combined. Seriously. But when that bubble violently burst in 1990, it kicked off literally decades of economic stagnation. To fight off a shrinking economy, the central bank was completely terrified of deflation. That fear forced them to keep rates at zero or even negative for decades until very recently in 2024.
But why was it so incredibly hard to get their economy heating up again? Well, it became this vicious structural cycle. Think about it. A rapidly aging population naturally consumes less. Scared companies hesitated to raise wages, and fierce global competition meant firms just couldn't raise prices. Ultimately, households just adapted to a low-inflation, low-wage reality. It totally trapped the economy, forcing those ultra-loose monetary policies for 30 long years.
Section 4. Why is the export giant struggling?
Let's peel back the next layer of the onion here with another really fascinating paradox. If Japan is an export giant, why isn't the yen strengthening? Basic textbook economics tells us that if a country exports a massive amount of goods, foreign buyers actually have to buy that country's currency to pay for them, which should drive the value up. So, what is going on? Why is the exact opposite happening today? The short answer? Globalization. See, back in the 1980s, everything was made inside Japan and then shipped out. But today, Japanese manufacturing giants have heavily offshored their production to the US, China, and Southeast Asia. So, when a Japanese company makes a massive profit selling cars in the US, they don't convert those dollars back into yen anymore. They just keep the profits abroad to build their next foreign factory. The money simply doesn't flow back home like it used to. It's a total game changer.
Section 5. Energy imports and pension funds.
We also have to talk about 2 massive yet often overlooked vulnerabilities that are draining the yen daily.
First up is the GPIF, the Government Pension Investment Fund. This is literally one of the largest pools of money on the planet. Because Japan's population is aging so rapidly, this fund desperately needs solid returns to pay its retirees. But with domestic interest rates at basically zero, they're forced to look overseas. So they take massive amounts of yen, sell it off, and buy foreign currencies. This single institution places a huge, constant downward pressure on the yen.
Compounding all of this is a severe energy crisis. Following the tragic 2011 Fukushima disaster, Japan shut down most of its nuclear power plants, and they had to shift heavily to importing liquid natural gas, oil, and coal. Then, when global energy prices spiked in 2022, Japan's import bill absolutely skyrocketed. And because global energy is priced in US dollars, every single time Japan buys fuel, they're forced to sell yen and buy dollars. It acts as this massive, heavy anchor just constantly dragging the currency underwater.
Section 6. 3 possible scenarios for the yen.
Okay, so now that we understand the deep structural causes, where do we go from here? Look, a return to the wildly powerful yen of the 1990s is highly unlikely. Scenario 1 is definitely the most probable, a slow, limited recovery as the US eventually lowers its rates and Japan slowly raises theirs. Scenario 2 would be a suddenly strong yen, but that would likely require a major US economic crisis where investors flee back to the yen as a safe haven. And Scenario 3? Permanent weakness, where the structural issues of offshoring and an aging population simply never get resolved.
But remember, a weak currency isn't universally bad for everyone. Every economic shift creates winners and losers. Right now, the clear winners are exporting multinationals making money abroad, and of course, foreign tourists finding unbelievable bargains. The losers, though, those are local businesses that rely heavily on energy, fixed-income households paying way more for their daily groceries, and regular Japanese citizens who suddenly find traveling abroad incredibly expensive. It is fundamentally reshaping daily life over there.
So what does this all mean? The crucial takeaway is this. The fall of the yen isn't just some story about a central bank turning a dial on interest rates. Not at all. It's the culmination of a 30-year structural and demographic transformation. A currency's value is really the ultimate mirror. It reflects how global capital flows, where giant institutions park their wealth, and how an aging population can change a nation's destiny. It's honestly a masterclass in modern macroeconomics.
Which leaves us with one final, kind of provocative thought to chew on. If a powerhouse economy, like Japan, with its massive tech industry and low unemployment, can have its currency completely transformed by shifting global capital, offshore factories, and an aging population, well, which major global economy is next? Thank you so much for exploring this with me today on The Explainer. I'll catch you next time.